Hey everyone, just wanted to make another quick video, talk about PayPal, which I just placed the trade, I guess yesterday technically. And so first I want to go over my valuation of PayPal, why I think it's undervalued, why I think it's unfairly punished in the market right now. And then second, I want to talk about a strategy that I have found very useful and helpful. And the strategy is called, I'm calling it, I personally like to think about it as the Airbnb options trading strategy. Some of you may know it as a poor man's covered call or diagonal spread, but I'll tell you why I kind of think about it as an Airbnb type investment where you're earning rental income. So really quick, this is the presentation from the fourth quarter full year results that PayPal had issued on February 1st. You can see that PayPal is not a small trivial company in the payment space. It's got, last year was in 2021, total payment volume through its system was 1.25 trillion. And they earned on a non-GAAP basis about $4.60. Current stock price, for context, is if I flip over here to the chart, about $100 a share, right? And it's fallen drastically from a high of over 300, which has been down, but we're coming into some really good support here, as you can see from this chart. The volume at these levels is super high back in 2019. And so I think we are pretty much bottomed out, and I will show you, on a fundamental basis that we're also pretty bottomed out. The valuation is very compelling. So in 2022, they expect to grow total payment volume to 1.5 trillion, and their cut of their payment volume is 29 billion. That's their revenue, the company's revenue. And so that's about a 15-17% revenue growth over the last year, over 2021. And if we were to exclude eBay, they're lapping some numbers where eBay was part of a bigger part of their payments, and eBay has decided to move away from PayPal, so they won't have that revenue going forward. So they're saying if you kind of eliminate the eBay effect, we'd actually be growing faster, 19 to 21% year over year. Earnings per share is about 460 to 475 in 2022. Now, if I look over here at Finbox, which Finbox is a service that I really like. You'll know from my past videos, I like to look at the numbers using Finbox. It is a paid service, but it's not. It's very reasonable. It's about $20 a month if you want to pay month to month. If you want to pay 1 year at a time, it equates to about $15 a month. So definitely doable, especially for those who are, if you're managing your own money, or any significant, any reasonable amount of money, right? It doesn't have to be a lot. It's worth paying $15-20 a month for this, so that you can see kind of how the numbers play out, how what a fair value might be for each of your stocks. And you obviously would want to sell them when they get overvalued and buy them when they're undervalued. So if I look at this, it's saying about $164 is the fair value for PayPal. It's basing it off of 13 different valuation models. So if I drill down, you can see these are the different valuation models that it is considering. And you can quickly see this earnings power value model looks like an outlier. If I take that out, actually, then my fair value jumps up to over 170. We'll leave that in. Still 65% upside from current levels, right? So that's what we like to see. And the narrative that we've been hearing in the market lately, with interest rates expected to go up, is that these high growth money losing, zero cash flow for the next 10-year companies shouldn't be valued as high when interest rates are going to be going up. But I do not put PayPal in that bucket of a high growth, zero cash flow or low cash flow company for, foreseeable future. This is a very cash flowing company. As you can see, free cash flow, levered free cash flow, over $5 billion last year. If I click into this, I can see the cash flow over the last 10 years definitely has been trending up, and over the last 4 years has been around $4 to $5 billion a year, which for a company that is selling the entire company, you could buy the entire company. For example, Warren Buffett could come in and buy this entire company for $110 billion. It's the enterprise value, right? So on an enterprise value basis, it's about 21 times free cash flow is what this company's trading at. It's got a free cash flow yield of just shy of 5%. So yeah, very compelling, especially when 10-year bond yields are 2%. You're getting a 4.7% free cash flow yield out of this company. And then if I look at the earnings projections, these are the analyst earnings projections here. Right here, you can see on this right-hand side for the next 10 years. You can see 5 years from now in 2026, earnings are expected to be $11.41, which is more than a double. If you double earnings in 5 years, that means you're getting a 15% compounded growth rate. That's just a nice handy trick for you to have in the back of your mind. Doubling in 5 years is 15% compounded annual growth. But we're doing more than double, so it's probably more than a 15% compounded growth rate. So in 5 years, this would be essentially, if you bought at today's prices, you'd be buying at 8.8 times, future 5-year earnings, right? So you'd be making more than a 10% earnings yield at that point on your cost basis. So interesting to think about, right? I mean, if you buy a rental property, like a physical, real estate property, could you in 5 years get a greater than 10% yield on that property? Be tough, right? PayPal is a pretty solid company, so it's not like we're buying a company that doesn't really have any brand value or doesn't have mind share in the market. We're buying one of the best companies in this space, I would argue. So that's the valuation. I think it's worth about 165. It's trading at 100. Now, how would I play this? Well, I want to talk about, I did another video where I talked about the same strategy. I want to talk about it again because I just absolutely love this strategy. And it's the Airbnb options trading method. So I say Airbnb because Airbnb investors, they're buying a long duration asset like a house or a condo, and then they're renting it out on a short-term basis for rental income, essentially, right? What a lot of people don't really think about is you can actually do the same thing with stock. So instead of buying real estate, you could buy stock. For example, I could buy 100 shares of PayPal and I could sell calls, which is essentially my rent, on that stock every month if I wanted to, and collect that income. Now, this strategy in particular, instead of buying stock, I'm going to buy as my long duration asset a long-term call, right? So I could buy a call option. For those of you who don't know what a call option is and don't understand options, watch just like an intro video on options. We're not going to go over it right now, but for example, I could buy an option that expires in January, so almost a year from now, about 11 months from now. And I like to buy the 80 delta. So this one's a 79 delta here. So I buy this $75 call option. That means I have the right to buy shares at $75. And then what I can do with this longer duration asset is I can sell shorter calls off of it. So I like to go about 30 days to expiration. This one's 28 days. The options that expire April 1st. I would sell the at the money call, meaning it's the strike price is right at the current stock price. So this $100 strike price, I could sell it for about, between the bid-ask spread here is about $615, so about $615. So I collect $615 in rent selling this 30-day call. So over the course of 30 days, I'll collect that $615 of rent. It will always decay because this is purely extrinsic value for an at-the-money option. It's 100% extrinsic value, meaning time value. So as time ticks by, this time value decays, and you will collect that. Now, that makes this total cost of the trade net is $27.20. You always got to multiply by 100 because options contracts are for 100 shares, so it'd be $2,720. So I'm going to pay $2,720 for this trade here. And let's look at the profit loss profile here. So at expiration, so at April 2nd, let me zoom in a little bit. My max profit is going to be right at $100 a share. And that's how it is with these, like I said, I like to call it the Airbnb options trade, but it's also called poor man's covered call or a diagonal spread with a deep in the money call. So it's going to have a downward droop because your short term, this April option will, if you look at the numbers, technically it's going to appreciate faster in value as the stock price goes up than your long duration option, but not by much. So there's a slight droop down. And in fact, you can control that droop. If you went really deep in the money, like if you bought the 50 call instead of the 75, that droop is lessened, right? It just costs you more. It costs you, about $4,600 now, $4,700. But for sake of, using your capital efficiently, maybe we don't want to put $4,700 into this trade. I'm going to put $2,700 into this trade. So we'd make $560, which is almost it's about a 20% return, right? If we get that max profit. Now, let's say the stock goes up to 120, still going to make, look down here in the left here, this box here, or you can see the number up here. Going to make about $250 if it's at 120, which is still almost a 10% return. And then even if it goes down to 95, you're still making $175. And if it goes down to 92.72, you're still breaking even. So your break even is down here at 92.70-ish. And so that's what I love about this trade is you can win in 3 scenarios. Stock goes up, stock stays the same, stock goes down a little bit. And by a little bit, I mean, this is still about a 7% drop you're protected from the current price. You still make money, right? So it's only in one scenario where the stock drops a lot would you lose money, okay? Now here's the really cool thing, and I'm actually starting a Discord, so if you want to join the Discord, comment below, because this is where I will put my trade ideas in the Discord. And those of you who want to join, as an early adopter, definitely I'll probably charge for it soon at some point, but I would do you a favor, right? Because you're helping me by joining, being one of the early adopters, helping me figure out what's interesting to you, what's not, what's helpful to you. It would be an educational component to it as well, like some live videos and stuff like that to talk about different trades, different stocks that I like that I think are undervalued. Anyway, so enough about that. But this is kind of a cool thing you can do. You can actually even decrease this break-even point even more for not very much more of an investment. So essentially, you could take part of that $615 that we are getting from selling the April call, and you could buy some protection, right? So let me add to this scenario buying a put spread. So I could buy the 95-90 put spread. So I buy the 95 put and I sell the 90 against it for 135 bucks. And for this put spread, max profit would be, the max value would be 500. Max profit would be about 365. So this will help protect my downside. So if I go back to this risk profile with both of these positions checked on, you can see this is now the profit loss gap, or graph. So it's kind of this mountain view but it's all positive, right? So we're still positive all the way down to 87.67 now, right? So from 92.70 to 87.67. So we dropped it by about $5, right? The break even. So we have another $5 of wiggle room to the downside where we're still profitable. The catch is that your max profit's going to be decreased by about the cost of this put, right? Because you're buying insurance essentially against this trade. So going back to the Airbnb analogy, right? You probably buy some insurance against the home that you're using for Airbnb. It's kind of cost of business. Here you can buy some insurance to protect your asset, still collect some rent, right? It's just going to cost you a part of your rent. And so the cool thing about these trades is you could do this every month, right? So once we get to April 2nd, this option is expired. We could sell another 30-day option. So for the May, a May option or whatever, collect another $600, right? And so in theory, if this price stayed the same, that's your ideal scenario, you'd collect $600 a month, which, pretty quickly you would gain back what you invested, the $2,700 or so. Obviously, that's in an ideal world. Stock's going to move up or down. So you don't. What happens? You won't be able to collect the max amount of rent, net $600 every month, but you might collect 300. Might collect 400 one month. Might collect 200. Might collect 100. You might have a month where you're always going to collect that rent because of the time value. Just mathematically how it works. You're always collecting that rent. The only thing that can happen is your long duration call, the 75 call, could decrease in value if the stock, if the stock really plummeted down to like 85, you're going to have a loss on this 75 call. But hopefully, the rent you collected over the last 6 months more than makes up for the loss in value from your long haul, and you're still profitable on the trade. But you can get really decent returns, like doing this over a year. It's pretty crazy what you can do. It's been a very challenging market. Everything just keeps going down day after day after day, and still I'm breaking profits on some trades after a couple months, and I think it'll just get better. I mean, at some point the market can't keep going down, or certain stocks can't keep going down, like PayPal, right? And so you're effectively challenging the market, like, hey, you're gonna have to drop even further for me to start losing money. And then the next month, I'm going to sell another call. I'm going to drop my cost basis even more, right? So this is a really, really cool strategy. If you want to learn more, like I said, comment below. I'll try and, if I have a Discord, I'll put the link in there. And I'll put a link to Finbox if you're interested in that for valuation as well. But until next time, have a great weekend, great week, and I'll talk to you again soon.